Okay, so today we're diving into the Q2 FY26 results for, well, one of India's biggest, most diversified companies.
Hmm.
But we're not just going to look at the raw numbers. We're trying to understand what happens when a giant like this gets hit by kind of a perfect storm, really. You've got global trade worries, serious operational problems from just too much rain across India, and then the short-term chaos from those big GST reforms kicking in all at once.
Exactly. And this deep dive, it's our way to quickly get a handle on, well, resilience. We need to figure out how a company that does everything, packaged foods, IT, cigarettes, paper, you name it, actually manage these unique pressures hitting them all together. Our mission really is to look past just the surface figures and focus on the smart moves, the strategies that let them protect their margins.
Right. And we're pulling everything straight from their official releases, the unaudited financial results, and the media statement for the quarter ending September 30, 2025. This quarter, I mean, it really feels like a test case for strategic strength and having that diverse portfolio.
Yeah, absolutely. To really get the performance, we need to set the scene first. India's GDP growth, Q1 FY26, it was pretty strong at 7.8%. So that's the background noise, economically speaking. But this company faced its own specific problems.
Yeah, I see that double whammy right away. At home, they had operations messed up by all that rain, plus that, short-term disruption from the GST switch. Those big structural changes, they rarely go off without a hitch at the start, do they?
They really don't. And then layered on top, you've got the global situation, shifting trade policies, geopolitical tensions, just general uncertainty. We actually see that bite later on. They mention customers delaying orders because of uncertainty around U.S. tariffs impacting some exports. It just shows how fast those external policy risks can hit your result. Doesn't matter how strong things are domestically.
Okay, so let's look at the numbers then. The performance report, maybe. Standalone gross revenue, if we exclude the agribusiness, was up 7.1% year-on-year. But here's my immediate thought. Profit after tax, PT, was up 4.1%. Now, given India's GDP was running hotter, like you said, 7.8%, is 4.1% PT growth actually that impressive? Or is it more about just managing decline well rather than real acceleration?
That's exactly the question, the critical way to look at it. On the surface, yeah, 4.1% looks, okay, maybe a bit slow. But the real strategic win here isn't just the raw PT growth number. It's how they defended their margins. Their EBITDA margin, that's earnings before interest, taxes, depreciation, and amortization, it jumped by a pretty sharp 185 basis points, climbed right up to 35.1%.
Wow, 185 basis points. Okay, so that much margin improvement, even while they're dealing with GST transition costs and commodity price issues, that's where the skill is, isn't it? It tells you their core cost structure is flexible enough to basically absorb the friction of a massive national economic change without, well, missing a beat.
Precisely. And they also mentioned a bit of a policy tailwind helping them. GST rates actually got cut on over half of their FMCG, their fast-moving consumer goods portfolio. And crucially, they passed those savings straight to consumers. So that's setting things up for maybe better volume growth down the road, building that consumption base. The earnings per share, the EPS, reflected this stability too. It went up to RS 4.13 from RS 3.98 the year before. Steady.
Okay, let's pivot then. Let's look at the main profit drivers, starting with the cigarettes business. Net segment revenue for Q2 up 6.8% compared to last year.
Right. And the strategy there seems pretty clear. Keep pushing the premium stuff, the differentiated brands, and keep working the market to fight against illicit trade. What's really interesting, though, is how directly they link government policy to their volumes. The documents flat out say that stability in taxes on cigarettes helps the legal industry get back volumes lost to the illegal market.
So tax stability isn't just about letting businesses plan better. It's actually a weapon against the black market. Makes sense. When the tax situation is predictable, the legal players can price more effectively, right? Pulling smokers away from illegal sources. That helps the company, obviously, but also the Indian tobacco farmers and government tax revenue, too. It's quite a compelling case for keeping policies steady there.
It really is. Now, let's shift gears to the other FMCG segment. This is really where they're pinning a lot of their future growth story. This part kept up strong growth, up 8% year over year if you take out the notebooks business. Notebooks, like paper, had some issues with cheap imports hurting things.
Okay, and the growth drivers seem pretty straightforward. Staples, dairy, premium personal wash products, and agribusiness incense sticks. But let's go back to margins again because that seems key. The segment EBITDA margin improved sequentially, meaning quarter on quarter it went up 50 basis points to hit 10%. Now, is 10% really like the big win? Or does the market expect something closer to maybe 12% before saying this segment is truly mature and highly profitable?
That's definitely the right question. Historically, yeah, the segment's margins were lower. They were investing heavily in building brands, distribution, all that. So hitting 10% is actually a pretty significant milestone. It's a bounce back from 9.4% in the previous quarter, Q1. And getting that jump sequentially while commodity prices were, as they put it, stabilizing at elevated levels, that shows their cost management efforts and their push towards more premium products are really starting to work structurally. They're absorbing those higher input costs. It does signal maturity, I think. They're using revenue management strategically now.
Okay, let's really unpack the playbook inside that FMCG other segment. They're clearly using innovation not just to sell more stuff, but specifically to build up those higher margins we were just talking about.
Exactly right. The game isn't just selling more basic Ashirvad Atta, their flour brand. It's about getting consumers to trade up. Look at what they're doing in staples. Launching these value-added lines like Ashirvad High Protein Atta. It's a blend with soya, Bengal gram, oats, things people perceive as healthier. That's a higher cost product, sure, but it commands a higher price, a higher margin. It taps into health trends and bumps up the average spend per customer.
And you see the same thing in the more indulgent categories too, right? Like with Bingo, snacks bringing out new potato chip flavors, or Sunfeast Dark Fantasy adding fancy dual fills cookies. The basic idea seems to be use the trust in the main brand to push these more premium, higher margin items.
Absolutely. Now let's talk about how they're selling channels. We're seeing a really strong push into what they call Nugent channels. So that's e-commerce, quick commerce, the super fast delivery apps, and modern trade, like supermarkets. This is critical because digital channels give them better customer data and maybe, over time, cheaper distribution too.
And that big push into digital has actually spun off whole new growth areas. Let's focus on that group of digital-first and organic brands they've acquired or built. This bunch includes names you might know like Yoga Bar, Mother Sparsh, 24 Mantra, it's now pulling in an annual revenue run rate, or ARR of about RZ's 1,100 crore. Just to remind you, ARR is basically projecting their current sales momentum out for a full year. That's a big number.
Yeah, that RC 1100 core ARR is huge. It's a massive vote of confidence in their strategy of buying and building these newer, modern brands. It proves they can actually scale brands that click with today's consumers, often outside their traditional shop networks.
You're talking about new areas. Let's touch on their food tech business. That's their cloud kitchen operation. This is where they take their food science know-how and apply it directly to the online food delivery market.
Right, and it's scaling fast. They're up to over 60 cloud kitchens now, spread across 5 cities doing various cuisines. The metric they use here is GNOV gross merchandise value, basically the total value of all the food sold through the platform. Their GMV passed RS 90 crore just in the first half of this fiscal year, FY26. That signals real traction, It shows they're serious about playing in this digital food space.
Okay, moving away from the high-growth FMCG side now, we definitely see some real headwinds in the more traditional sectors, particularly paperboards, paper and packaging. This segment clearly dragged down the overall EBITDA growth figures we saw earlier.
That's right. The whole industry there is getting hit by a nasty combination. First, a constant flood of cheap imports, low-price supplies coming in, and at the same time, domestic wood prices are high. That really puts a squeeze on margins for local producers. It's tough.
But the report mentions a sequential improvement in Q2. Segment profit up 17% quarter-on-quarter, margins up 90 basis points QOQ. Was that just things bouncing back naturally, or was something else going on?
This is where you really have to read between the lines. The real story isn't the 5% revenue growth. The real story is that without some very specific regulatory help, this whole segment would likely be losing margin badly. They're leaning pretty heavily on government action to fend off those cheap imports. Specifically, the government brought in a minimum import price, an MIP, on a type of paperboard, virgin multi-layer paperboard, that kicked in back in August 2025.
Right, MIP. They also mentioned anti-dumping duties, ADDs, have either been recommended or are being investigated for paper coming from China, Chile, and Indonesia. So just for listeners, MIPs and ADDs are basically tools governments use to shield local industries from foreign goods being sold unfairly cheap. They put a price floor under imports.
It's a very clear example of where competing against global dumping, frankly, needs policy backup. Now, that same kind of global uncertainty also hit their agribusiness, but in a different way. Net segment revenue there was down sharply, 31.2% year over year in Q2. But the company notes this was mostly about timing differences and comparing against a very high number last year. Crucially, performance for the first half of the year, H1, was still positive overall.
Okay, but what was the specific issue hurting agri exports?
It was the value-added agri exports. They slowed down because customers delayed their orders, their call-offs, and this was linked directly to market uncertainty caused by U.S. tariffs.
So there you have it. Global trade policy hitting two different major segments, paper and agri in different ways, needing different kinds of policy responses or just creating friction.
Right. Before we wrap things up, just a couple of quick corporate housekeeping points to mention. The board gave the nod for a voluntary delisting of their shares from the Calcutta Stock Exchange, the CSE. They'll stay listed on the main exchanges, the NSE and BSE, just consolidating, really.
Okay. And for anyone tracking their big restructuring, remember the hotel's business, except for the ITC Grand Central in Mumbai, is now treated as discontinued operations in the accounts. This just reflects that demerger plan that officially started back in January 2025. The idea there is to unlock more value for shareholders in the longer run.
Exactly. And finally, we really should touch on their ESG performance, environmental, social, and governance. It's a big part of their identity and, frankly, a key differentiator. They talk a lot about their triple bottom line performance, and honestly, the track record is pretty extraordinary.
Yeah, it's not just corporate speak. The numbers are there. They've been water positive for 23 years, carbon positive for 20 years, and solid waste recycling positive for 18 years straight. That's sustained commitment.
It really is. And they also kept their high MSCI ESG ARI rating for the 7th year running. That's actually the highest rating among global tobacco companies. It shows their focus on being a responsible business is real, it's verified, and it gets recognized globally. That helps attract long-term investors who care about these things.
So if we pull together all these pieces from the quarter of the margin defense, pushing towards that 10% in FMCG, relying on policy and paper, what's the main takeaway for you, for our listeners?
Well, I think the Q2 results really show how effective their diversification and their agile cost management can be. They managed to absorb some pretty severe external shocks by strategically focusing on higher margin growth in FMCG others, particularly through premium products. And they used the stability of the cigarettes business as a foundation to kind of ride out the immediate storms, like the GST transition and those high commodity prices. It's basically portfolio management under pressure, isn't it?
Yeah, and it all seems to tie back into their bigger picture strategy, what they call the ITC Next strategy, that focus on future tech, being consumer-centric, and responsible competitiveness.
Which brings us to maybe a final provocative thought for you, the listener, to chew on. We've seen clearly this quarter how two major segments, cigarettes and paper, had their performance explicitly linked to government actions, whether it was tax stability helping fight illicit trade in cigarettes, or MIPs and ADDs protecting paper from cheap imports. So given this pretty clear reliance on policy support on these regulatory shields, just consider how much of this giant company's future growth, its competitive strength, really depends on continued proactive government policy versus just pure consumer demand and their own innovation. Is their resilience more about market smarts, or is it partly underwritten by regulatory protection? Something to definitely think about as you watch how they navigate the next few quarters.